Hey, what's going on, guys? My name is Aaron. In today's video, we're going to be talking about AMC stock. That's right, AMC, American... Wait a minute, what does AMC even stand for? Do you know what AMC stands for? One second here. American Multi-Cinema. Did you even know that? I've literally never heard of that before. Anyway, as many of you know, AMC stock has been on an absolute tear recently. So in today's video, we're going to be talking about some reasons behind the recent price increase and some predictions going forward. If you enjoyed the content, please leave a like on the video, subscribe to the channel, and let's get right into it. Okay, so AMC stock. Now, just to preface, when it comes to understanding why particular stocks move how they do, there are always many different reasons and many different catalysts that move stocks. Now, in today's video with AMC specifically, we're going to be focusing on the short squeeze and the gamma squeeze and how those two factors are some of the primary drivers behind AMC stock movement. Okay, so getting right into it, AMC stock has been on a massive rally this past week. Just in the past 5 days, AMC went from trading at $19 to trading at over $60 per share. Even today, Wednesday, June 2nd, AMC went up over 100% in a single day. So this stock clearly has a ton of upwards momentum to it. Okay, so getting into our first catalyst behind AMC's price movements, we're going to be talking about a short squeeze. Okay, so for a brief explanation, a short squeeze works something like this. Let's say that hedge fund A thinks that AMC stock is overvalued and it's going to drop. So instead of buying the stock, which is you betting that the stock is going to rise, you can short a stock. And shorting is when you bet that the stock is going to fall. So hedge fund A does this like this. Hedge fund A goes to their broker, and what they essentially do is they borrow, let's say, one share of AMC stock from their broker and then sell that one share directly onto the market. So let's say they borrow one share of AMC stock at $30 and then they sell it onto the market at $30. Now hedge fund A has $30 in cash and they're short one share of AMC stock, which they owe to their broker. Now, let's say that the hedge fund's right and AMC actually ends up dropping. So in order to profit and cash out of their position, what the hedge fund does is they then buy the stock back, now at a lower price, return that share to their broker and profit the difference. So in this case, let's say that they borrowed that share of AMC for 30 bucks, they sold it onto the market, so they have 30 bucks in cash now, and let's say AMC stock drops to $10 per share. What they can now do is take $10 out of that 30 that they have now in cash and buy one share of AMC stock back at $10 per share. They can now return that one share back to their broker and they profit the difference. In this case, because they sold AMC initially on the market for 30 and then bought it back at 10, they now have a $20 profit. That's them profiting the difference. Okay, so when it comes to analyzing whether or not we have a short squeeze potential for AMC stock, we have to look at the short interest. Now, the short interest just shows you what percentage of the shares on the market for AMC are being sold short. Obviously, the higher the number, the more people are shorting the stock, meaning the more people are betting that the stock is going to drop in value. Now, it's very important to understand whether or not the short interest is high or low, because if the stock price ends up rising dramatically, this puts a lot of pressure on the shorts. Now, remember in our example, when the stock ended up dropping, the shorts made money. But what if the opposite happens? What if the stock ends up rising? Well, remember, as the stock ends up rising, in order for the shorts to close out of their position and end their shorts, they have to buy the shares back from the market. But if the share price ends up rising to a price higher than they initially started at, well, then in order to buy the shares back from the market, they're going to have to upfront and pay more cash to buy those shares back and close out their position. In other words, they're going to be losing money. Remember, in the example, if they sold the shares on the market for $30, but then instead of the stock dropping at $10, it rose to $60, well, now they have to spend an additional $30 as well as their initial $30 to just close out of their position. So they're losing money in this transaction. Okay, so now we get into the short squeeze potential. So the short squeeze can happen when you have a lot of institutions that are shorting the stock, but there's a very limited supply of actual shares outstanding because whoever else is holding the stock isn't selling. Now, this was the drama we witnessed back with Gamestop, and we're seeing it again with AMC. What we have is 80 to 90% of all the shares of AMC are being held by retail investors. Now, there's this whole movement going on, as we know, on Wall Street Bets and all these trading forums that these AMC holders aren't willing to sell their shares. Now, this is very interesting because when you have all these shareholders not willing to sell their shares to the shorts, which need to buy shares in order to close out of their positions, you end up in this situation where you have an extreme amount of demand for the stock, but very few people actually selling the stock to those shorts. So what this demand supply crunch ends up doing is it forces the stock price higher, which forces more and more shorts to have to close out of their position, and they'll ultimately pay whatever price is necessary in order to close out of that position. Now, it's important to realize the short interest right now for AMC is around 18 to 20% of float. Now, this is important to remember remember, because back in January, the short interest for GameStop was over 140%. So right now, clearly we don't have the same amount of short interest as we had back then. But again, this doesn't mean a short squeeze is impossible. Remember, the vast majority of shares of AMC are being held by retail investors. And if those retail investors are willing to hold onto the shares and not sell, we could find ourselves in a situation where the price continues to rise and it squeezes out more and more institutions that are still shorting the stock. Okay, catalyst number 2, this is going to be the potential for a gamma squeeze. Now, most people aren't really talking about a gamma squeeze when it comes to AMC, but honestly, this is quite possibly one of the major catalysts behind this recent price increase in AMC stock. Okay, so gamma squeezes work something like this. You have, let's say, Robinhood. Now, Robinhood sells options. Specifically, they sell call options to investors like you and me. Now, remember, a call option grants the buyer the right to buy 100 shares of a particular company at a particular price at a particular date. So if you're Robinhood and you're selling call options to retail investors like you and me, you have to prepare for the potential that I'm going to exercise that call option upon the expiration date and I want to buy 100 shares from you. So then if you're Robinhood, you have a contractual obligation within that call option to deliver me those shares upon execution. Now, this is where the gamma squeeze comes into play. Remember, a bunch of people are buying these call options because AMC stock is going up. Now, the more call options they buy, the more underlying shares Robinhood is forced to purchase behind the scenes because, again, they have to prepare for the potential that all these people buying call options are going to want to execute them. So now you have Robinhood who's buying hundreds and hundreds of thousands of shares of AMC stock simply because they're selling so many call options, but simply the action of them buying all those underlying shares in the background further adds to the upwards pressure into the demand of the stock. And again, this works in a loop where the more shares that Robinhood has to buy in the background, the higher the price ends up going for the stock. And the higher the stock price ends up going, the more people end up buying call options, which forces Robinhood to buy more shares, which forces the cycle to continue. And of course, this isn't just Robinhood who's doing this. This is every single broker that's writing call options for individuals. Okay, so in the end, whether this turns out to be a short squeeze or a gamma squeeze or maybe a combination of the two, I would play this similar to how you would play GameStop when it comes to trading the stock. Remember, when it came to GameStop, if you were able to get in early enough and sell early enough, you could have made a ton of money. And I suspect the same thing is probably going to end up happening with AMC. Right now we're at $65. I bet the price is going to continue to rise as we saw with GameStop. However, the problem comes that we don't know when it's actually going to start capitulating down. So if you're thinking about buying in, if you're thinking about trading it, just remember you're buying it now at a very elevated price with a lot of risk. There is the potential that these institutions could continue to get squeezed out and the price could continue to rise, but we don't know that for a fact, and any money you invest in it right now is essentially gambling. So as always, never invest more than you can actually afford to lose with these very risky types of plays, and they should only make up a very small percentage of your net worth and of your investment portfolio. I want to thank you for sticking through today's video. Please go ahead and leave a like, subscribe to the channel, and I'll see you in the next one.
Yeah.